I was working with a few foundations and DAOs. We realized that their treasuries weren't really being managed, either on the token side, but also on the stablecoin side.
Yeah.
So can you give us a little bit of an overview? What are you doing at the moment, sort of for teams, and how are you working with them?
Sure. Yeah, so as you mentioned, we've moved into the sort of DAO treasury management space, which is fundamentally it's very similar to traditional treasury management for companies. If you think about a DAO, um, it's a decentralized organization, but still one that generates revenue or cash flow in its native token. It has real world expenses through its foundation companies. And it's got a certain runway in its native token. Okay, that native token though is incredibly volatile, and it's usually highly concentrated in the DAO. So it's very difficult to forecast the future value of that token. It's difficult to forecast what you're going to be able to liquidate it at. And especially when these DAOs launch, the protocols are in no way sort of profitable. This takes quite a long time usually, but there's very high overheads initially. So apart from all of your setup costs and your marketing costs, you've got your directors' fees, your legal fees, admin fees, and these all are quite significant costs. The last thing you want, and I'm talking especially here around sort of mid-sized DAOs, is to have situations where at any given point you only have 2 months worth of runway in stable assets, liquid stable assets to service all these expenses. And then you go through a bear market. Because, the big DAOs, like the Uniswaps of the world, if their multi-billion-dollar treasury goes to $1 billion, they're going to be fine. They're going to be able to weather a bear market. They're going to meet their OPEX. The smaller guys, the secondary market liquidity dries up. It's very difficult to liquidate their native token. And it can create sort of a compounding effect as well. If the community or the token holders see what's happening and sees all the liquidations happening from the DAO, they don't want to hold on to their token either anymore. So it creates this kind of compounding effect, and the token ultimately just gets destroyed. So when times are good, that's difficult to know when it's good, but you ultimately want to be putting a financial plan in place to diversify the treasury to at least have 18 to 24 months worth of runway.
So I think it's very true. I mean, if the token price is down and the DAO has to sell, that's not a very good position. And I mean, the token holders will also then start selling.